Now remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comments section below where I show you guys how to close out of any options trade. Also guys, if you haven't already, make sure to check out Webull. Right now you can get 12 free stocks valued up to $32,000 by using my link in the description below. So go ahead and check out Webull guys. Now let's get right into this video. So firstly, why is the strip straddle a volatile option strategy? Because it's best used when you are expecting a significant move in the price of the security. Now, this strategy is designed to be used when your volatile outlook has a bearish inclination. So in other words, what this means is that you believe that a big drop in the price of the security is more likely than a big increase in the price of the security. However, this strategy will still allow you to make money both ways. So what you want to do here is you want to find a stock that you believe is going to be rather volatile. In other words, you expect the stock to move quite a bit in price, but you're more bearish than bullish. So again, you believe the price is more likely to drop than it is to increase. Now, this strategy can get expensive. So if you have a smaller account, you may want to stick with stocks that have a lower share price. So for today's video, I'm going to use ticker symbol AAL. This is American Airlines, which is currently at $12.23 a share. So you'll see that with a stock like this, it isn't that expensive. Now, in the last week, American Airlines was down 10.3%. So this would have been a great strategy to use on American Airlines if you had been, if you had thought American Airlines was going to be volatile this past week. Now, again, everything I'm about to show you here is just an example to show you how to set up the strategy and how it works. So don't copy this exact same trade, guys. Now, before we actually go into the options here, remember, you always want to first check for commission fees. We are going to be opening and closing multiple contracts here. If you're on a broker with high commission fees, that might eat away at a lot of your profit. Now, Robinhood doesn't have any commission fees. We don't have to worry about it on here. Now, number two, we're only going to be buying options. That means that you don't have to worry about being assigned. There is no risk of assignment here, okay, guys? So let's get into the options here, and let's talk about the strip straddle. Now, the first thing you want to do here is you want to choose a proper expiration date. The idea, again, is that the stock will make a pretty decent move before then. Hopefully, it's to the downside because you will make more money that way. But again, if it moves up enough, you can also make money as well here. Now, I'm just going to leave my expiration as it is, September 30th, which is this coming Friday. Now, we want to start by creating a straddle here. So remember, a straddle is where you buy a call and you buy a put. They both have the same strike price and they both have the same expiration date here. So I'm just going to go ahead and buy a call. I'm just actually going to choose the at the money call option here just for the example again. But you can kind of mess around and see kind of how that changes the outlook of it. But I'm going to go ahead and buy the at the money call. So remember, the at the money option is the option whose strike price is as close to the current share price as possible. So current share price is $12.23. So what strike is as close to $12.23 as possible? It's this one right here at the $12 strike. This is the at the money call. So I'm going to buy the at the money call here. Now, again, with a straddle, you need to buy a call, buy a put with the same strike. So I'm going to switch over to put now, and I'm also going to buy the at the money put. So that's going to also be the one at the $12 strike here. And again, they also have the same expiration. So as you can see, Robinhood recognizes this as a straddle here. Now, here is where we're going to do something to modify this so that it's not a straddle. It turns into a strip straddle. So here's what we're going to do. What we need to do now is we need to buy more puts now. Now, how many puts you buy here is really up to you. And again, you can kind of, use option strat to visually see how that's going to change your trade. The more puts you buy, it's also going to be more expensive. The more puts you buy, usually you're only going to buy one more put. So usually you're going to buy the call, you're going to buy a put, and then you're going to buy another put. And normally you're going to buy the put with the exact same strike as the put that you're already buying here. So I'm going to go ahead and go over here, go to custom, and then for the put that I'm buying, instead of buying just one, I'm going to go ahead and buy two. Again, you can experiment with, buying three, buying four, just kind of see how that changes the trade. But I'm only going to go ahead and buy one more here. So we're buying a call, we're also buying a put, and then we're buying another put here. So this is what the strip straddle looks like. You're going to enter this for a debit. As you can see, this example would be about $125. So again, not extremely expensive here. And again, this is going to allow us to make money both ways here now. So again, before you ever enter any trade, I recommend using an option strat to visually see what your trade will look like, what your profit and losses might be here. So let's go over to option strat and let's take a look at what this trade will look like visually. So let's go to build here and we'll just start at long call here. So we're already on American Airlines here. We chose we left our expiration date as was, right? So September 30th. And then, okay, I said first, we want to go ahead and buy a call. I just bought the at the money call, which is the $12 strike one. So it's already there, already buying that call. Now I said, okay, basically we're entering a regular straddle first. So we also need to buy a put with the same strike as the call that we're buying, right? So this is a straddle. And as you can see, option strat recognizes this. Now I said, okay, now what we want to do is we need to buy more puts. And again, you can buy as many more puts as you want. Generally speaking, though, you're only going to want to buy one more most of the time. So I just said, okay, so the put we're buying, instead of just buying one, let's go ahead and do two here. And so this is what it ends up looking like right here, right? So again, you're entering this for a debit, $124. Again, if you're using a more expensive stock, this is going to be more expensive as well. So keep that in mind. The most you can lose is the amount you pay for these three options here. Max profit is infinite on the upside. On the downside, of course, it's capped since the stock can only drop to $0. And then you actually see this here now, chance of profit. You won't be able to see this unless you have the premium version of Option Strat. If you're interested in the premium version of Option Strat, I'll put a link in the description below where you guys can sign up and get 25% off. You may have noticed a couple of other things, right? Like this up here and a couple of other things that I'm seeing that you're not. Again, that's because I have the premium version here. But according to this, the chance of profit here is 41%. Again, this is just an example here, but that might be useful to you. And then we have our break evens here. So let's actually take a look here at what this could potentially look like here. So I'm not going to zoom out so far out yet. I'll just leave it right here, right? So again, we have our break evens over here. So at expiration, you want it to be below 1138 to make money or above 1324 to make money. So let's say expiration date comes and the stock is down 9%. You would make about $56, right? If it was down 9.1%. What if it instead went up 9.1% by our expiration? So up 9.1%. Notice here, you're still going to make money, but it's not going to be as much, right? You'd only make $8 in that situation versus $56 if it had gone down 9.1%. So again, that's where this, that's where what I mentioned earlier comes in, right? You can still make money both ways here, but you're going to make more if the stock goes down for the same percentage move here. Right, so we'd want it to go down 9% versus going up 9%, even though you make money in both situations here. So again, you want to have a stronger inclination to the downside here than to the upside. So let's say it drops 11%. You'd make $112. What if it goes up 11%? Again, you'd still make money, but it wouldn't be as much. It'd only be $36, as you can see here, right? Now, the other thing I do want to mention here, guys, is that for this strip straddle, right, there's only one place where you will, lose all your money, where you will actually lose your max loss, 100%. That's only if at expiration, the price of the stock is exactly at the strikes you chose, right? Which is a $12 strike. So if at expiration, the share price is exactly at $12, that's where we would end up actually losing 100% of our investment. Beyond that, there is no other place here where you would lose 100% of your investment, right? So keep that in mind as well. It is very, very unlikely you'll ever lose 100% of your investment here. But, there is definitely kind of a wider area here where you would lose some of your investment. So again, you want to use this on a stock you believe is going to be rather volatile. It's going to move quite a bit here. Now, remember, you can close out of this at any point in time here, guys. So let's say, Wednesday comes and it's dropped 12%. According to this, you'd be up about $136. So at that point, you can close out of it and take your $136 profit. You don't have to wait until the expiration. You don't have to let them expire. The other thing, of course, we always want to check is changes in implied volatility. So let's say IV starts to go down here. We should know by now this is going to be bad, right? Because when you're buying options, which is the only thing we're doing here, we're only buying options. When you buy options, you want IV to go up. If it goes down, you're going to see more red, as you guys saw, right? A lot more red here. However, right, if it goes up, you're going to see a lot more green here. So you also want IV to go up once you enter this strategy here, right? So again, you want to do this when stocks are volatile. So if you guys have any questions about anything I just talked about, feel free to leave them in the comment section below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.